1. U.S. retail sales surge despite tariffs. What you need to know. 2. U.S. retail sales growth and steady job market. How they affect the Fed's rate cut decision. 1. U.S. retail sales surge despite tariffs. What you need to know. In a surprising twist, American consumers proved their resilience last month, even as the effects of President Donald Trump's tariffs began to ripple through the economy. Retail sales surged more than anticipated in June, signaling that shoppers are still willing to spend despite growing concerns about rising prices. But here's where it gets controversial. While this might look like an economic win on the surface, the underlying story is far more nuanced. According to data released by the Commerce Department, retail sales climbed by 0.6% in June compared to the previous month. This marked a strong rebound from May's sharp 0.9% decline and exceeded economists' expectations, which had forecast only a modest 0.2% increase based on a FactSet survey. One standout category was car dealerships, where sales jumped by an impressive 1.2%. It wasn't just cars driving the growth, spending rose across multiple sectors, painting a picture of widespread consumer confidence. However, there's a catch. These figures don't account for inflation, meaning they aren't adjusted for price changes caused by factors such as tariffs. When you factor in June's 0.3% rise in consumer prices, the real gain in retail sales shrinks to a more modest 0.3%. While this adjustment tempers the initial excitement, it doesn't diminish the fact that Americans are still spending freely, for now. And this is the part most people miss. Even small increases can be significant when viewed against broader economic trends. Digging deeper into the numbers reveals some intriguing patterns. For instance, restaurants and bars, a key indicator of discretionary spending, saw a solid 0.6% bump in June. Typically, when budgets tighten, dining out and entertainment expenses are among the first things people cut back on. The sustained demand in this area suggests that many households remain comfortable with non-essential purchases. Another telling metric comes from what's known as the control group of retail sales. This measure excludes volatile categories like gas stations, car dealerships, and building materials, offering a clearer snapshot of core consumer behavior. In June, this figure rose by 0.5%, once again surpassing economists' forecasts. Such strength underscores the idea that, at least for the moment, consumer spending remains robust. On Wall Street, investors reacted cautiously but positively to the news. U.S. stocks edged higher on Thursday, with the Dow Jones Industrial Average climbing 75 points, or 0.17%, after opening lower. Meanwhile, the S&P 500 remained stable, and the tech-heavy Nasdaq Composite ticked up by 0.1%. These moves reflect cautious optimism, as market participants weigh whether consumers will continue to power the economy amid tariff-induced price hikes. Heather Long, chief economist at Navy Federal Credit Union, summed it up succinctly in her commentary, "Don't count the American consumer out yet." She acknowledged widespread anxiety about potential price increases due to tariffs but noted that bargain hunting remains alive and well. Consumers seem willing to open their wallets if they perceive value, suggesting that deals and discounts could play a pivotal role moving forward. Yet, not all corners of the retail landscape are thriving equally. The Federal Reserve's latest Beige Book report, compiled from surveys conducted before July 7, highlights mixed results. Discount stores and warehouse clubs reported robust sales gains, likely driven by savvy shoppers seeking bargains. On the flip side, spending on apparel and footwear softened noticeably, particularly in the Chicago Feds district. Interestingly, though, a department store chain in the Northeast shared encouraging news, citing improving sales in denim and fine jewelry. Restaurant visits in Brooklyn and other parts of New York City also showed continued momentum. The labor market further complicates the narrative. Unemployment remains low, layoffs are minimal, and employers are steadily adding jobs, all positive signs for sustaining consumer spending. A separate Labor Department report revealed that new applications for unemployment benefits fell for the fifth consecutive week, dropping to 221,000, the lowest level since mid-April. Additionally, June's job creation figures beat expectations, with employers adding 147,000 positions and the unemployment rate dipping slightly to 4.1%. But here lies another layer of complexity. For those currently unemployed, the situation isn't quite so rosy. Ongoing claims for jobless benefits, filed by individuals who have been receiving payments for more than 1 week, crept upward in early July, reaching nearly 1.956 million. Although this is slightly below June's peak, it hints at challenges for job seekers navigating a slower hiring environment. As Nancy van den Houten, lead economist at Oxford Economics, pointed out, unemployed workers are finding it difficult to find new jobs in a labor market where hiring is slow. So, what does all this mean for the future? Will consumers keep spending as tariffs push prices higher? Or will we see a shift toward thriftier habits? These questions linger unanswered, inviting debate and discussion. Do you think the American consumer can weather these economic headwinds? Share your thoughts in the comments, we'd love to hear your take. 2. U.S. retail sales growth and steady job market, how they affect the Fed's rate cut decision. Have you ever wondered how retail sales and job market data can influence major economic decisions? It's a fascinating intersection that often sparks debate. For instance, recent data showing U.S. retail sales growth and a steady job market has stirred the pot regarding the Federal Reserve's interest rate decisions. Retail sales increased by 0.6% in June, a figure that exceeded expectations and suggested a modest improvement in economic activity. This development has given the Federal Reserve some breathing room to delay cutting interest rates while they assess the impact of import tariffs on inflation. But here's where it gets controversial. Some experts argue that the increase in sales might be due to tariff-driven price hikes rather than actual volume growth. And this is the part most people miss. While the headline numbers look positive, there are subtle indicators that inflation is eroding some of the gains. Core retail sales, which exclude volatile categories like autos and gasoline, rose by 0.5% in June, but this was accompanied by a downward revision to May's figures. Meanwhile, initial jobless claims fell to a 3-month low, consistent with steady job growth, and this is great news for the labor market. However, there are rising risks, such as trade policy uncertainty and slowing wage growth, which could impact consumer spending and labor market stability. So, what does this all mean for the Federal Reserve? Despite the positive retail sales and job market data, experts predict that the Fed will keep its benchmark interest rate unchanged at its upcoming policy meeting. The central bank is under pressure from President Trump to lower borrowing costs, but the data suggests there's little pressing need for another rate cut. However, the debate continues, and this is where your opinion comes in. Do you think the Fed should cut rates, or should they wait and see how the economy evolves? Let's discuss in the comments below.